17 days, not months, not years. 17 days. Silver just added hundreds of billions in market value in a single session, while physical supply tightens behind the scenes. One institution issuing nearly all of it, and inventories falling as the calendar counts down to February 27th. Ask yourself this. If even a fraction of March contracts demand metal instead of paper, what happens next? Is this just another volatile cycle? Or the moment the system gets tested in real time? Stay with me, because what unfolds over the next 17 days could redefine how this market functions. Welcome to Market Metal. If you're joining us today, especially those of you who've been watching markets longer than many of us have been alive, consider subscribing. Think of it as pulling up a chair at the table so we can walk through this data together, calmly, clearly, without noise. And before we begin, tell me in the comments, where are you watching from today? The countdown, understanding the 17-day delivery window. 17 days? That is the timeline now sitting quietly on the calendar. Not a dramatic headline, not a social media trend. A date, a procedural deadline inside the silver futures market that most people never think about. But serious market participants understand that in commodities, deadlines matter more than opinions. Silver is approaching what professionals call first notice day. This is the point when holders of futures contracts must decide whether they want the contract to settle in cash or stand for physical delivery. In normal times, very few contracts move into physical delivery. Most traders close their positions before that stage. Futures markets are built on leverage and liquidity, not warehouse logistics. But this moment is not entirely normal. Over the past several months, the number of contracts moving into delivery has increased. At the same time, the amount of registered silver, metal that is officially available and tagged for delivery, has declined. That combination creates a tension that cannot be ignored. When obligations rise, while available inventory falls, professionals begin to pay attention. To understand why this 17-day window matters, one must first understand how the system works. A futures contract for silver represents an agreement to buy or sell 5,000 ounces at a set price. These contracts trade daily. Most are never settled with physical metal. Instead, traders offset positions before expiration. That system works smoothly when trust in the structure remains intact. The assumption is that if someone truly wants delivery, the metal will be there. The delivery test is simple in theory. If enough participants stand for delivery at once, the exchange must provide the metal. If only 2% to 5% of open contracts request delivery, the system handles it easily. That has been the historical pattern for decades. But what if that percentage rises? What if 10%, 20%, or even more decide they want physical bars instead of paper contracts? That is where the mathematics begins to matter. At present, open interest in the upcoming March silver contract remains elevated. Against that, registered inventory has declined significantly compared to prior months. While total inventory numbers still appear large in headlines, only the registered category is immediately available for delivery obligations. This distinction is critical. Not all silver in vaults is deliverable. Some is owned by long-term holders, some is pledged, some is categorized as eligible but not registered. The delivery test applies only to the registered category. If delivery participation remains historically low, there is no issue. The system clears as usual. But if participation rises toward recent elevated levels, the ratio between obligations and available supply tightens quickly. For entrepreneurs and business leaders, this may sound technical. But it is not abstract. Silver is not just a financial asset. It is an industrial input. It is used in solar panels, electric vehicles, electronics, medical devices, and emerging technologies. If pricing becomes unstable or supply chains tighten, businesses that rely on silver face cost volatility and procurement risk. That is why serious capital allocators monitor these structural signals. They do not wait for mainstream headlines. By the time a shortage appears on the front page, the pricing adjustment has already occurred. The 17-day countdown is therefore not about predicting a price spike. It is about observing whether the system clears smoothly or shows signs of stress. Recent market behavior has added complexity. Silver experienced sharp volatility earlier in the year, falling significantly from its January high before stabilizing. Price action alone, however, does not tell the full story. During that same period, physical premiums in certain regions remained elevated. Delivery volumes increased, inventory levels declined. These signals suggest that price volatility in paper markets does not always reflect physical conditions. Historically, commodity stress emerges quietly. It begins with subtle shifts, rising lease rates, widening spreads between regions, slightly higher delivery percentages. None of these, in isolation, signal crisis, but together they create a pattern. Experienced observers understand that markets are systems of trust. When participants believe that paper contracts represent real, accessible supply, liquidity flows freely. But if confidence weakens, even slightly, behavior changes. More participants may choose delivery. Fewer may be willing to lend physical metal. Spreads widen. The next 17 days serve as a checkpoint for that confidence. If March delivery proceeds with participation within historical norms, the narrative resets. Volatility stabilizes. The system absorbs demand. Businesses continue planning as usual. If participation climbs meaningfully higher, the delivery ratio becomes a public metric. Analysts begin recalculating coverage ratios. Financial media takes notice. That does not automatically mean failure. It means pressure. For decision makers, pressure in commodity markets translates into risk variables: pricing volatility, hedging costs, procurement lead times. The disciplined approach is not to assume disaster or dismiss concern. It is to model scenarios. Scenario 1. Delivery participation remains moderate. Inventory declines slightly but remains manageable. The event passes without disruption. In this case, silver remains volatile but functional. Scenario 2. Delivery participation rises beyond expectations. Inventory coverage ratios narrow sharply. Cash settlements increase. Premiums widen. This scenario introduces price instability and forces repricing of risk. Scenario 3. External catalysts amplify the situation. Inflation data, currency movements, or geopolitical developments increase demand simultaneously. Under such circumstances, what was manageable becomes accelerated. These are not predictions. They are frameworks. The business community must understand that commodity markets operate in cycles. Extended deficits, declining inventories, and rising industrial demand create structural pressure over time. Delivery windows act as stress tests within that larger cycle. The key lesson is discipline. Markets reward preparation, not reaction. Over the next 17 days, professionals will watch 3 indicators closely: daily inventory changes, delivery notices, and regional premiums. They will not rely on social media commentary. They will rely on clearing data. The broader economic context also matters. Inflation expectations, interest rate outlooks, and currency strength influence speculative positioning in metals, but delivery mechanics reflect physical demand. In the end, this moment is less about excitement and more about verification. The system is being asked a simple question: can obligations be met smoothly under current conditions? If the answer is yes, confidence strengthens. If the answer shows strain, markets adjust. For young entrepreneurs and aspiring business leaders, the deeper lesson extends beyond silver. Every industry contains structural pressure points. Most of the time, they remain invisible, but deadlines expose them. 17 days is not a dramatic timeline in historical terms. Yet, in markets, short windows often reveal long-term realities. The countdown is not about fear. It is about awareness. Serious participants do not wait for certainty. They observe the test as it unfolds. And over the next 17 days, the silver market will quietly reveal whether its current structure remains balanced or whether deeper adjustments are beginning. The structural deficit, a problem that cannot be printed away. The delivery window explains timing. The structural deficit explains inevitability. Behind the daily price charts and futures contracts lies a quieter, more powerful force, a 5-year imbalance that has been building without interruption. For 5 consecutive years, the world has consumed more silver than it has produced. Not by a narrow margin, but by hundreds of millions of ounces in cumulative terms. That imbalance is not theoretical. It is arithmetic. Annual global production has hovered in a relatively stable range, yet industrial consumption has continued to rise. Solar manufacturing has expanded. Electric vehicle production has scaled. Semiconductor output has grown. Artificial intelligence infrastructure demands more conductive materials. Military and aerospace applications remain steady consumers. Silver sits inside all of it. When a deficit occurs for 1 year, markets absorb it through inventories. When it occurs for 5 consecutive years, inventories become the shock absorber, and shock absorbers eventually wear down. What makes this deficit uniquely dangerous is not its size. It is its structure. Unlike oil or copper, silver is rarely mined for its own sake. Roughly 70% to 80% of global silver supply comes as a byproduct of mining other metals: copper, lead, zinc, and gold. That means silver production does not respond quickly to silver prices. Even if the price doubles, miners do not suddenly open silver-only operations at scale. Production decisions are tied to the economics of entirely different metals. This is the constraint many overlook. Entrepreneurs often assume that higher prices bring higher supply. In many industries, that is true. In silver, it is not immediate. Opening a new mine requires regulatory approval, environmental assessments, infrastructure investment, and years of development. The average timeline from discovery to production can stretch 7 to 10 years. 7 to 10 years. Markets, by contrast, adjust in weeks. That mismatch between physical development timelines and financial cycles creates volatility. It also creates strategic opportunity for those who understand it early. The 5-year deficit means inventories have been quietly bridging the gap. Vaults, exchange warehouses, private holdings, these have supplied what mines could not. But inventories are finite, and as they decline, their strategic importance increases. Consider how governments behave when a resource becomes strategic. They restrict exports, they monitor flows, they reclassify materials. Recent policy moves in major economies suggest that silver is increasingly viewed not just as a commodity, but as an industrial necessity tied to energy transition and technology sovereignty. For business leaders, that shift is profound. When a material transitions from tradable commodity to strategic resource, price discovery changes, supply chains tighten, political influence enters the equation, long-term contracts replace spot purchasing, hoarding behavior increases. The deficit is not merely about ounces, it is about control. Solar panel production alone consumes significant volumes of silver paste. As renewable energy targets expand globally, this demand is not cyclical, it is policy-driven. Electric vehicles require silver in electronics and battery management systems. Semiconductor fabrication relies on conductive precision. These sectors are not shrinking. At the same time, recycling cannot fully offset demand. Silver recycling contributes supply, but much of the metal used in industrial applications is dispersed in small quantities across devices. Recovery is complex and often uneconomical at scale, so the deficit persists. For aspiring entrepreneurs, the lesson is clear. Structural constraints outlast market headlines. Volatility in price may create temporary dislocations, but the underlying imbalance remains. The delivery window discussed in Part 1 is a short-term stress test. The structural deficit is the long-term driver. If demand continues at current pace and mine production remains constrained, one of three things must happen over time. Prices rise sufficiently to incentivize new supply. Demand is destroyed through substitution or slowdown. Strategic stockpiles become prioritized, limiting open market access. None of these outcomes are instant, but each changes business planning. Consider a manufacturer dependent on silver inputs. If procurement becomes uncertain, inventory management shifts. Companies increase buffer stock. Working capital requirements rise. Cost forecasting becomes unstable. Margins compress unless pricing power exists. Capital allocators notice these shifts before they appear in quarterly earnings. They track deficit years. They monitor production reports. They evaluate geopolitical policy signals. They ask not whether the next week will be volatile, but whether the next 5 years will look different from the last 5. The 5-year deficit also intersects with financial positioning. When investors begin to understand that physical supply cannot quickly expand, behavior changes. Delivery participation rises. Leasing costs increase. Physical premiums widen. These are not isolated anomalies. They are symptoms of the same underlying imbalance. The key point is discipline. Structural deficits do not explode overnight. They tighten gradually until they reach inflection points where small increases in demand trigger disproportionate price moves. That is why serious observers are focused on this moment. The delivery test in 17 days is not happening in isolation. It is happening at the end of 5 consecutive years of imbalance. Markets often appear stable until they are not. For business leaders, preparation means scenario planning. It means evaluating exposure not just to price volatility, but to supply access risk. It means understanding how strategic metals fit into broader geopolitical frameworks. For young entrepreneurs, it means recognizing that industries built on scarce inputs require adaptive strategies. Diversification of suppliers, long-term contracts, hedging mechanisms, alternative materials research. The structural deficit is not a rumor. It is a multi-year reality, and realities eventually assert themselves. If the delivery window passes quietly, the deficit remains. If it passes under strain, the deficit accelerates its visibility. Either way, the imbalance does not disappear. It accumulates. And accumulation in economics is rarely neutral. Paper versus physical. When two prices tell two different stories. If the structural deficit explains pressure, the paper versus physical divergence explains tension. For decades, the silver market functioned under a simple assumption. The price displayed on a futures exchange represented the true value of silver everywhere. A contract in New York, a bar in London, a shipment in Asia, all were connected by arbitrage. If prices drifted apart, traders closed the gap quickly. But recently, that connection has shown strain. In multiple regional markets, physical silver has traded at noticeable premiums to Western futures prices. After accounting for local taxes and withdrawal costs, buyers in certain jurisdictions have effectively paid double-digit percentage premiums above the paper price. That gap is not trivial. In efficient markets, a 1% difference attracts immediate arbitrage. A 10% difference demands explanation. Sustained divergence suggests friction, either in logistics, policy, or access to deliverable metal. This is where serious observers shift from watching price charts to examining mechanics. The exchange for physical, EFP, spread provides one signal. The EFP measures the cost of converting a futures contract into physical metal outside the exchange warehouse system. Under normal conditions, this spread remains small, a logistical adjustment reflecting storage and transport costs. When that spread widens sharply, it suggests something different. It suggests that acquiring physical silver is becoming more expensive relative to holding paper claims. At the same time, lease rates, the cost to borrow physical silver, have moved higher. Lease rates are often overlooked by retail participants, but institutions watch them closely. When holders of metal demand higher compensation to lend it, it indicates caution. They are less willing to part with physical inventory. That behavior signals scarcity. Add to this the reports of elevated retail premiums. Coins and small bars have traded at significantly higher markups over spot compared to historical norms. Government mints have temporarily paused or limited distribution in certain periods, citing supply chain constraints. Skeptics may dismiss these as retail anomalies. But professionals understand that retail demand often acts as an early indicator of broader sentiment shifts. It is not the driver of the global silver market, but it can reflect tightening conditions. The more important observation lies in institutional behavior. Delivery participation rates have risen. Open interest remains meaningful. Inventory levels have declined. At the same time, physical premiums in specific regions have not compressed, even during periods of paper price weakness. That is the crucial detail. Normally, when futures prices fall sharply, physical demand cools, premiums shrink, buyers wait. Instead, in recent episodes, physical premiums have remained elevated or even expanded during price pullbacks. That suggests two markets operating simultaneously. One market trades contracts, the other accumulates metal. When paper prices fall due to liquidity events, margin calls, speculative unwinds, macro shocks, physical buyers may interpret lower prices as opportunity rather than signal of weakness. If that pattern continues, it creates asymmetry. The futures market can adjust prices downward quickly. But if physical demand absorbs supply at those lower prices, inventories decline faster. That decline feeds back into delivery ratios. Delivery ratios feed into confidence. Confidence feeds into behavior. And behavior determines whether paper markets remain dominant in price discovery. For business leaders, the significance lies in signal interpretation. If regional premiums remain elevated while exchange prices fluctuate, procurement managers must decide which price reflects actual cost. If delivery spreads widen, hedging strategies require recalibration. If lease rates rise, financing costs for metal-backed operations increase. The divergence also has geopolitical dimensions. Some jurisdictions have treated silver as a strategic material. Export restrictions, domestic allocation policies, and industrial prioritization can distort global flows. When sovereign actors classify a resource as critical, they do not necessarily signal it loudly, but their policies reveal it quietly. Over time, if physical silver becomes more concentrated in certain regions while paper trading remains centered elsewhere, price discovery may shift geographically. That is not a prediction. It is a structural possibility. History provides precedent. Commodity pricing power has migrated before, from one exchange to another, from one region to another, when physical control and financial control diverged. The suspense in the current environment lies not in daily volatility, but in alignment. Are paper prices accurately reflecting physical tightness? Or are they temporarily disconnected due to speculative positioning? The 17-day delivery window will offer partial insight. If delivery participation rises and premiums remain firm, it reinforces the view that physical demand is active beneath the surface. If participation falls and premiums compress, divergence narrows and the system resets. But if divergence widens, if paper volatility continues while physical tightness persists, market participants will begin asking more serious questions about price discovery mechanisms. For entrepreneurs, the deeper lesson is this. When markets show signs of bifurcation, risk modeling must adjust. Two price systems imply two realities. Procurement decisions cannot rely solely on exchange quotes if actual sourcing costs differ materially. Strategic businesses do not panic. They observe patterns. And the pattern emerging is subtle but significant. Physical indicators are not fully aligned with paper volatility. That misalignment is not yet crisis. But in commodity markets, sustained misalignment often precedes rebalancing, either through price adjustment or structural reform. The tension between paper contracts and physical access is not new. What is new is the persistence and magnitude of recent divergence. 17 days remain before the delivery window tests that tension. When obligations meet inventory, theory meets reality, and reality in commodity markets ultimately prevails. The delivery math, when deadlines meet. Reality, 17 days is a short window in politics. It is a brief moment in corporate strategy. But inside a futures exchange, 17 days can separate routine settlement from systemic stress. Now, the focus shifts from theory to arithmetic. The upcoming March contract holds a substantial number of open positions. Each silver futures contract represents 5,000 ounces. When multiplied across tens of thousands of contracts, the notional exposure reaches into hundreds of millions of ounces. Against that sits registered inventory, the metal officially designated and available for delivery. The ratio between those two figures is the core tension. Historically, delivery participation remained modest. 2 to 5% of contracts stood for physical settlement. The system functioned smoothly because only a fraction of open interest translated into warehouse movement. But recent months have shown higher delivery participation. That change alone alters risk calculations. If 25% of open interest stands for delivery, the coverage ratio tightens sharply. If 50% stands, the stress becomes visible. If participation approaches extreme levels, arithmetic dominates narrative. It is not necessary to predict exact percentages. What matters is the direction of participation. Business leaders understand leverage. When obligations exceed readily accessible assets by several multiples, outcomes become sensitive to small behavioral shifts. A minor increase in delivery demand can create disproportionate pressure on available supply. This is not about dramatic collapse. It is about confidence thresholds. Confidence in a futures market rests on the assumption that contracts are convertible into the underlying asset if required. If that assumption is tested, even without failure, participants adjust their expectations. There are 3 broad pathways forward. First, delivery clears without disruption. Participation remains elevated but manageable. Inventory declines but does not approach critical levels. In this scenario, volatility remains contained and the system demonstrates resilience. Second, participation exceeds comfortable thresholds. Inventory coverage becomes narrow, cash settlements increase, potentially at premiums. The exchange fulfills obligations, but market participants take note of strain. In such an environment, price volatility may accelerate as risk repricing occurs. Third, rule adjustments or emergency mechanisms are introduced. While rare, exchanges retain authority to modify conditions under extreme stress. Such actions may preserve order but can reshape perception of market integrity. Each scenario carries implications beyond silver. For industrial users, elevated delivery participation signals that supply chains require attention. Long-term procurement contracts may need reassessment. Buffer inventories may become prudent. Hedging strategies may require recalibration. For financial institutions, margin models adjust based on volatility. Capital requirements shift. Risk desks monitor exposure concentration. For entrepreneurs, the message is broader. Markets under pressure reveal structural realities that calm periods conceal. The suspense in this moment does not come from dramatic headlines. It comes from alignment of variables. Inflation data releases may influence currency strength and rate expectations. A stronger dollar can suppress commodity prices temporarily. A weaker dollar can support them. Liquidity cycles in broader markets may spill into metals, but delivery arithmetic remains independent of narrative. If inventory declines continue at current pace, registered supply tightens further before first notice day. If daily delivery notices accelerate, coverage ratios compress. If regional premiums persist, physical demand remains active. These indicators are observable in real time. Professional capital allocators are not asking whether silver will explode. They are asking whether the exchange will clear March smoothly, and what the outcome implies about underlying supply constraints. History shows that commodity markets rarely shift gradually once structural pressure meets deadline mechanics. Adjustments often appear sudden because they accumulate quietly beforehand. Silver has experienced generational bull cycles before. It has also experienced sharp corrections. But in each case, delivery windows acted as inflection points, moments when leveraged positions reconciled with physical availability. The current environment contains layered complexity. 5 consecutive years of structural deficit, industrial demand growth, geopolitical resource prioritization, and increased delivery participation. When multiple stressors converge near a deadline, markets become sensitive. For decision makers, the response is not speculation, it is preparation. If March clears uneventfully, confidence strengthens, and structural deficits continue to build gradually. If March clears under visible strain, repricing risk accelerates. Either outcome provides information. The true risk lies in ignoring the test altogether. Young entrepreneurs often focus on revenue growth and market expansion. Yet long-term resilience depends on understanding input volatility. Silver, though often viewed as a financial asset, is deeply embedded in modern infrastructure. Its pricing and availability influence industries far beyond bullion trading. 17 days is not about excitement, it is about verification. Can the exchange deliver under elevated participation? Can inventory levels sustain increased demand? Will premiums compress or widen? These questions will be answered not through commentary, but through settlement reports and warehouse data. Markets reward those who observe pressure points before they become headlines. As first notice day approaches, the silver market is not promising spectacle. It is presenting a test. And in markets, tests do not shout. They reveal.